Hello, this is Kyler Worth of AAII. We are talking about the latest and greatest from the world of finance and investing for the individual investor. We're broadcasting, and if you're watching this in the archive, we post our upcoming live show schedule on aai.com/webinars. And AAII members will have access to the full archive of shows. Our guests today are Matthew Crouse, Charles Ruppelt, and Matt Bykowski. Today's show has 3 topics. First, we discuss the advantages and risks closed-end funds present to the individual investor. Next, we run down the guidelines for selecting stocks for your portfolio using the 4th step in the PRISM method. Finally, we take a look at the hottest sector ETFs. Let's get started. I'm joined now by Matthew Crouse, Assistant Finance Professor at Westminster College in Salt Lake City, Utah, and winner of the 2016-2017 Gore School of Business Adjunct Faculty of the Year Award, to talk about closed-end funds and the risks and advantages they pose for investors. It's great to have you here, Matthew.
Thank you, Kyler.
So, why would an individual investor choose to purchase closed-end funds over mutual funds? Are there scenarios where an investor could purchase both?
Yes, there are 2 main reasons why I buy closed-end mutual funds over regular funds. The first is leverage, and that's the ability of funds to borrow at a cheap rate and then invest in higher yielding assets. And this allows closed-end mutual funds to pay higher dividends than you get in open-end mutual funds. And that's one of the key attractions. The other key feature I like is the ability to buy at a discount. Closed-end funds are traded on the stock exchange, and their market price can often be different from their net asset value. Unlike an open-end mutual fund where you always trade with the fund company at the net asset value. And so closed-end funds can trade at premiums and discounts. And I like to opportunistically buy funds when they're at large discounts and look for some potential for capital appreciation as those discounts narrow when sentiment improves. Those are the 2 reasons that I recommend buying closed-end mutual funds. Another reason that some investors give, it's less important for me, is that closed-end mutual funds can own more illiquid assets. These are assets that don't trade very often, or there's not a very well-established market for. One example is private loans to companies, or investments in private companies. And closed-end mutual funds, they can invest in those more so than open-end mutual funds because they have a fixed asset base. And so that's another reason that some individuals like to invest in closed-end mutual funds. In terms of whether to own open-end or closed-end mutual funds, I own both. And I personally put my long-term, buy and hold type investments more in open-end mutual funds and ETFs. And then my more opportunistic investing I use for closed-end mutual funds.
Of the list of factors mentioned in your article that have an influence on the supply and demand of CEFs, are there any that are more significant than others, or is it more of a case-by-case matter?
Yeah, first I'll talk about the general factors is market sentiment is a key driving factor. If you look in the article, there's a chart of how closed-end discounts can really widen during bear markets. For example, last year, during the COVID scare, the peak of the COVID scare, discounts were about 20% on average, or actually median discount was 20%. Whereas right now, the median discount's around 2%. So you can see right there, that's a huge difference. And so that's in terms of the general market. So general market conditions and basically optimism and pessimism in the market really drive discounts. In terms of for a particular fund, some important things are long-term track record. And so if a fund company has a good long-term track record or is viewed as highly skilled in a certain sector, then their funds can trade with small discounts or even good premiums. And then funds with a bad track record tend to trade at discounts. So that's one key determinant. Another determinant is the level and direction of dividends. And so funds that pay like higher dividend yields, like yield percentages, tend to trade at smaller discounts or premiums. Also, the direction of dividends. So if dividends are like increasing, that's a good thing. Those funds tend to trade, with smaller discounts or premiums. Funds that have had dividend cuts tend to see price drops and more discounts. And so that's why I also like to look at company earnings. You can look at closed-end fund company earnings and compare those earnings to the amount of the dividend, which can sometimes give you a clue as to whether a fund will be raising or lowering its dividend.
What risks should individual investors be aware of when purchasing closed-end funds?
One of the main risks is that in a bear market, closed-end funds tend to trade down a lot more than open-end funds. And there are two main reasons for this. The first is the leverage. And again, leverage is borrowing money. And so say a fund has a dollar in NAV, they borrow 25 cents on that dollar. Well, if there's a drop in NAV in an open-end fund of say $1, well, the closed-end fund will drop $1.25 because it owns those extra assets. It has more sensitivity. And so with that leverage, these funds tend to drop more when there are bear markets. Also, the discount effect. As you might guess, like if the discounts are 2% now, and in a bear market they go to 20%, that means you've lost like an additional 18%. Now, those are often like short-term price swings, but they really can increase the volatility and the short-term pricing risk on your closed-end mutual fund. Basically, I mean, the basic risk there is that people will only buy your fund at a more heavily discounted value. So if you needed to sell quickly, you would get, less for your fund. One final risk relates back to the earnings type thing, is that you generally don't want to own closed-end funds in front of dividend cuts. So if there's a dividend cut in a fund, that it generally can trade down significantly. And so you kind of want to be on top of that to avoid those kind of pitfalls.
Well, you mentioned how closed-end funds are susceptible to losing assets in a severe bear market. Are there any strategies that the individual investor can use to help prevent this scenario while investing in closed-end funds? Or is this just a risk that individual investors should take into account when choosing to put their money in closed-end funds?
That's a great question. I mean, it's definitely a greater risk that you should always be aware of, but there's some things you can do to mitigate that risk. One is to buy funds that aren't overly leveraged. And you can look that up. I mentioned this in an article, but on CEF Connect, you can find statistics on the amount of leverage that your fund is using. So funds that use, lesser amount of leverage are going to be less risky, in a bear market scenario. The other is looking for funds that have a good long-term track record, where the fund managers have performed well through bear markets and kind of have been shown to be able to navigate that. The other thing is to look at owning funds with less risky and less concentrated assets. For example, during the COVID crisis, diversified stock and bond funds held up pretty well. But for example, sector MLP, master limited partnership funds, these are funds that are generally heavy on oil and gas assets. A lot of them were highly leveraged in a highly risky sector. And so when the market dropped, in order to preserve their borrowing covenants, they had to sell a lot of assets at the bottom. And most of those funds have not recovered from that. And so, sticking to safer and more diversified sectors, that's another thing that can mitigate risk. And finally, one thing that I do is I look at the risk reward closed-end funds. And so I will own less when the risk reward is not as good. Say when discounts are are small, and maybe the assets look more overvalued, and then I buy more, as opportunity improves. So I think through all those kind of measures, an investor can reduce their risk.
Are there any specific reasons why investors should look at closed-end funds now? Have the recent global changes like the pandemic had an influence, positive or negative, on closed-end funds that investors should be aware of?
I think now's a great time to start looking at closed-end funds. Um, to be honest, I wouldn't be putting all my assets in right now because closed-end discounts are narrow. They're averaging around 2%, whereas like in the peak of the crisis, it was around 20%. That said, also, I'd like to mention that I don't think bonds or stocks are that cheap right now. The yield on the 10-year Treasury bond is below 1.5%. I don't PEs on the stock indices are high right now, and so I wouldn't necessarily be like loading in when the discounts are narrow and maybe when the assets seem expensive. However, now is a great time to learn about closed-end funds so that when the next opportunity comes, which could be with like rising interest rates, like there's a concern that with inflation that interest rates will rise, and that tends to be a good time to buy closed-end funds. Like discounts tend to really widen in a rising rate environment. As well, if there's just a general market sell-off due to COVID or some other reason, that can be a great opportunity to buy. So I think now's a great time to maybe dip toes and learn about closed-end funds. They are complicated. It takes a while to learn them. And so if one learns about them now, then they can be prepared when a good buying opportunity does occur. And in terms of what happens with COVID, COVID gave a great short-term buying opportunity for closed-end mutual funds, like getting funds at 20% discounts. That was a very great opportunity, but it was very short. The window is very short for that. Actually, after that, after the panic subsided, it's kind of made closed-end funds more expensive because the Fed has been supporting the market with low interest rates. And when you have low interest rates, that tends to lead to higher prices for closed-end funds because folks are starved for yield. Like if they can't get yield off their normal US Treasury or normal bond fund, then that will make them gravitate towards a little bit riskier closed-end funds that have higher yields. And so that's made closed-end funds expensive right now, in my view. So that's been the impact of COVID overall.
Well, thank you so much for joining us today. We very much hope we can have you on again.
Yeah, thanks a lot for the opportunity, Kyra. Appreciate it.
Of course. And if you're interested in learning more about closed-end funds, you can find Matthew's article, The Advantages and Risks of Closed-End Funds, in the August Journal at aaii.com. Thank you once again, Matthew, and have a great day.
Thank you.
Today, I'm joined by Charles Ruppelt to discuss the fourth step of the PRISM process, selecting and managing stocks. How are you doing today, Charles?
I'm doing well. How are you doing, Kyler?
I'm doing excellent. Let's jump right into this. Each individual investor has their own financial situation and environment they live in. As such, the investing strategy that works for one may not work for another. How does PRISM, more specifically the fourth step, help investors choose an investing strategy that fits their needs?
Sure. So PRISM follows a top-down approach to investing. We believe an investor's goals to drive their risk tolerance, which in turn affects their asset allocation needs. So once you start going through that funnel, it becomes easier to select stocks because you're really looking for what stocks fulfill my allocation needs. So do you need large cap stocks? Do you need small cap stocks? Perhaps you're looking for international stocks. So you're really taking this broad universe of stocks. And in the United States, there's ballpark about 5,000 exchange listed stocks. So trying to say, oh, I need a stock, let me go look at this big pile of 5,000 stocks is a bit like trying to find the needle in a haystack. But if you know I need small cap stocks, and that immediately narrows down the universe. Now, if you have personal preferences in terms of style, that narrows down the list even further. So perhaps you need small cap stocks, but you also have a preference for value. Well, all of a sudden, you're not looking at 5,000 or so stocks. You're looking at just those stocks that are small cap value stocks, and then from there you can narrow it down further, looking for using your rules. So the whole idea about PRISM is you're actually narrowing down your investment choices to find those that really match what goals you're trying to accomplish. In the case of stocks, any personal preferences you have in terms of factors or investing styles. And I will add, there is research that suggests our preference in terms of being a growth investor or a value investor is partially set at birth. So if you're a diehard value investor, you're probably not going to be doing so well with growth strategies. And if you're a diehard growth investor, then it might be very hard for you to actually treat yourself as a value investor because it just goes against who you are as a person.
Reducing the number of available stocks to choose from allows the individual investor to have an easier time creating their portfolio. However, this also reduces the number of potentially successful stocks for them to choose from. Is it worth the individual investor looking beyond their stock style in order to avoid missing the bigger picture?
No, I don't think it is. And again, I think it comes down to your personal preferences. But taking a step back, I think if you're going to be a stock investor, an individual stock investor, you have to ask yourself, well, what am I trying to accomplish? Am I trying to get higher returns? Am I trying to get more income? Because if your goal is, I'm going to pick individual stocks and I want to get the market return, you should just buy the index fund. An index fund will do it with a lot less effort, for a lot less cost, and will give you that market return. So your goal is, as an individual investor, to have returns that are different than the market. And these are long-term returns that are different than the market. That also means you need to be comfortable having returns that are different than the market, because if you're a value investor, you're going to have periods where you underperform the market. If you're a growth investor, you'll have periods, say like the years of 2000 through 2009, where you'll underperform the market. If you're a dividend investor, you'll get more income, but you'll get fewer capital gains. But over the long term, you'll achieve your goals. So if your real long-term goal is, hey, I want more income, then you might be willing to give up something in terms of capital gains. If you're a big believer in, say, value momentum, and I really believe this factor works over the long term, I've looked at historical records showing it works over the long term, you might be better prepared to deal with those shorter periods where it doesn't necessarily work as well. So styles can really help you, and factors can really help you outperform over the long term, but it's really important to realize we are talking over the long term, and there will be shorter periods where you may not be as comfortable. Now, the advantage, however, is you will have the opportunity to get higher long-term returns. You'll also have an easier time picking stocks and selling stocks, because you know, based on your style of investing, you'll be able to set rules, and you'll know my rules are X to buy and Y to sell, and you'll be able to consistently follow that process. And just having that discipline will automatically give your returns a boost over what they otherwise would be, because you do have those clear buy and sell rules. You're not sitting there looking at a stock, should I keep it? Should I buy it? Should I sell it? It's very clear as to whether or not the stock meets your rules or not.
Will there ever be a reason an absolute basis number changes? Will this change come from the investor's own financial decisions or from the broader changes in the market?
Sure, and that's a great question. So when we talk about absolute basis, it's really, what is the absolute numbers I'm using in my buy and sell rules? A value investor might say, I require a price to book ratio of no higher than 3. A growth investor might say, I want growth rates, be it sales and or earnings, of at least 10%. A dividend investor might say, I want a yield of at least 2%. Now, the nice things about those rules is they're very clear. If you're a growth investor and you want a growth rate of 10%, you're not going to look at anything with a growth rate, say, of 5%, or maybe it's negative. At the same time, if you're looking to sell a stock and you bought the stock and it was growing at 15%, and now maybe it's growing at 2%, you might look at that stock and say, well, that's no longer growing at double digits. I'm going to sell it and find something that's growing stronger. So those absolute rules, when you put them to buy and sell rules, help really well. The problem is that market conditions do change over time. And so depending on the market conditions, those absolute rules might find more stocks or they might find fewer stocks. Now, you don't necessarily have to have those numbers be set. For our model shadow stock portfolio, our price to book rule for buying a stock is a price to book ratio of no higher than 1.1. That is based on the cheapest 10% of all stocks listed on New York Stock Exchange. So as the markets go up and stocks become more highly valued, that 1.1 might actually be adjusted upwards, so it's always reflecting that bottom decile. But say the market pulls back and stocks are being cheaper, we'll actually lower that price to book ratio to say maybe 1.0, maybe 0.9, so it's still reflecting the bottom 10% of stocks, but we still have that clear line that we know at that point we're going to only buy stocks that are below that price to book ratio. The flip side is there are strategies, for instance, like William O'Neill's CanSlim approach, which has some very specific numbers regarding momentum, very specific numbers regarding growth. Depending on market conditions, that might fund you a lot of stocks, but if you're in a market that's falling, or perhaps you're in a recession, and there might be cases where you have a hard time finding stocks, and strategies like that use those hard numbers as a cue to say, this is a good time for investors following the strategy to be buying stocks, and this is not a great time for investors following the strategy to buy those stocks. So there is a timing element at play, but some people like having the absolute numbers where it's very clear as to what you should do, what you shouldn't do, and also in terms of how much you should be in the market. It is a tactical approach, but some people like having that clarity.
In the article, it is mentioned that momentum indicators can be combined with other styles. Are there any other types of stock styles that can be combined or work off of each other?
Absolutely. And it's almost like creating a recipe that certain ingredients go well and certain ingredients you can experiment with. Momentum, for instance, goes really well with value because momentum and value tend to be uncorrelated. So the momentum really looks for outperforming stocks. So it's looking for stocks that are popular. Value looks for stocks that are undervalued, stocks whose prospects investors are undervaluing or don't really think are as great as they really are. So when you combine them, you're really getting a case where you're looking for stocks that are a bargain in terms of value, but then in terms of momentum, you're finding stocks that other people are looking at the stock and saying, that stock's underpriced. I think it's going to go higher, so I'll buy it as well. But momentum can certainly be applied with growth. I mentioned the William O'Neill strategy before. That's a growth plus momentum strategy. Value and growth can be combined together. It's an approach known as growth at a reasonable price, where you're looking for growth stocks, but you don't want to pay too much in terms of valuation to own them. Dividends can be combined with valuation. So I'm looking for strong dividends, but I don't want to overpay. Yield is useful as a valuation indicator. There are dividend growth strategies where you're looking for stocks with growing dividends. So you can combine things. And even with size, we know over the long term that if you buy undervalued stocks that are small market capitalizations, meaning small cap value, over the long term, that has realized these highest returns. But what I will say is whenever you start combining two or more styles or two or more factors, it makes the strategy more complex. And that matters because you may not know why the strategy is particularly working well or why it's not working well. So if you do small cap value and it's doing well, you may not know by looking at your returns whether it means that value is working or that size is working. And it really plays more of a role when the strategy is not working. You may not know if it's small cap that's dragging down or if it's value. And so that can make the strategies hard to follow because they're not as intuitive. Now, that might sound like a bug, but it's actually a feature because when you do things like that, it means other people have a harder time following the same strategy. And anytime a strategy is less popular, but it has an economic and a behavioral reason why it should work, such as small cap value, meaning that in this case, not a lot of people aren't looking at these stocks, and so they tend to be more mispriced. This bug of people not always understanding it, this bug of it's not necessarily being intuitive, really isn't a bug, it's a feature, because it keeps the strategy from being too popular. And whenever the strategy's not too popular in investing, it's a good sign that what caused that strategy to outperform in the past is going to allow it to continue to outperform in the future. So there's definitely an advantage to combining factors, and particularly when those combinations have been shown to work over the long term. And those include small cap value, value momentum, dividend, and growth. Those things combined have tended to work well over the long term.
Thank you for your time, Charles. If you would like to learn more about PRISM and building your portfolio, you can find Charles's article, Guidelines for Selecting Stocks for Your Portfolio, and others like it in the August Journal at aaii.com. Have a great day, Charles.
Thank you, Kyler. You too.
Today, I'm joined by Matt Bykowski to discuss the latest hottest sector ETFs. How are you doing today, Matt?
Oh, I'm good, Kyler. I'm getting a little less anxious for these each time.
Oh, that's great to hear. Hopefully that trend continues. Let's get right into this. On the list, the Wisdom Tree Cloud Computing ETF holds the top spot with 12.9% a 1-month return. However, its 1-year annualized return, 43.4%, is significantly lower than the next 5 ETFs on the list. How much of a concern should the previous year's annualized return affect an individual investor's decision to invest in a company on the rise right now?
Well, when it comes to discussing the performance or really any metric of a fund or ETF, you have to compare peer to peer. So this means by category in this case. So each fund has an assigned category that will have average metrics that individual investors should measure an individual fund against. So when we're looking at the first cut list of sector ETFs, if you skip down to the next tech fund, it's number 9 on the list, the iShares Expanded Tech Software Sector ETF. You'll notice that it actually has a similar but slightly lower 1-month return than the Wisdom Tree Cloud Computing ETF. So there are also other tech ETFs further down on the list with they have better 1-year returns, but worse 1-month returns. So the Wisdom Tree ETF just happens to have the best performance of its sector. And then when we rank that with the other sector funds, it has the best performance in the table. So for our screens, they rank returns relative to a fund's category peers. So what appears on this list is the top performing fund within a category. And then those top performing sector funds are ranked by performance against each other. So we have a cutoff at 25 for the print version of this article. In total, when we did this screen, there were 27 ETFs that met all the first cut criteria for June. As far as how much of a concern you should have over the previous year's annualized return affecting a decision to invest right now, it shouldn't when looking at specifically this first cut list, because it's not in an individual investor's best interest to make an investment in a fund based off 1-month returns. Funds and ETFs tend to be longer term investments. So you want to look at longer term returns beyond 1 year even, including 3-year and 5-year. There's no reason to chase any of the hottest funds, sector or otherwise, because there's no guarantee of short-term performance transfiguring into predictable long-term performance. Looking at the hottest sector funds allows you to understand what economic forces are moving the market right now. So maybe you'd want to tilt your portfolio toward a sector or category that has good performance, or you can understand why your portfolio is under or overperforming. But again, individual investors should be looking to compare long-term performance. Over time, that washes out the luck that drives short-term wins.
In order to qualify for passing, ETFs must have at least 100 million in total assets and 10,000 shares. What are these metrics required in order for an ETF to pass?
Yeah, so the answer is pretty simple. These metrics are in place to ensure that the ETF has enough liquidity and investor interest to remain a viable fund to invest in. If you're looking at ETFs, you want to be reasonably able to buy and sell shares when your investment plan calls for you to do so. So if a fund is small in terms of assets under management, or just doesn't have a large amount of shares trading every day, It's just going to be harder for it to perhaps exist in the long run, and it's going to be harder for you to make your own investment decisions as far as buying and selling.
As mentioned in the article, the miscellaneous ETFs all involve clean energy. So, the two categories that dominate the hottest sector list are technology and energy. Based off the numbers, is this energy and technology trend reliable in the long term, or should investors treat those industries as temporary investments?
Yeah, so I'm going to appeal back to my answer to your first question, Kyler, and that the hottest ETFs or funds are not a reliable read on long-term performance. It's definitely a temporary trend, and especially when we're thinking about future long-term performance, which is what matters in the end with any type of speculative investment. What we have is historical data to look at and observed patterns between past performance and future performance. But these things aren't absolute. So like, for instance, I briefly checked the hottest sector ETFs for July just before this recording, and 4 of the top 5 ETFs are in the health category. They're not in the tech or energy categories. And the top health ETF only had 1 month return of 5.9%. This compares to the Wisdom Tree cloud computing ETF we talked about, which had 12.9% return in June. In July, even that fund itself only had 2.7%. Despite it having a large difference in 1 month return, the 12.9% to 2.7%, even for July, the Wisdom Tree ETF still had a category ranking of an A grade for its performance. So, it all remains very, very relative to what is occurring between funds and categories. And short-term trends such as the hottest sector ETFs are incredibly relative to the current moment. So investors just can't rely on a 1 month trend for long-term performance.
Thank you so much for joining us today, Matt.
Thanks, Skyler.
You can find his article, Hottest Sector ETFs, and others like it in the August Journal at aaii.com. Once again, thank you, Matt. Have a great day. Hi all. If you weren't aware, we record this show in advance of the broadcast date, and we do like to answer questions in our listener mailbag segment. We didn't receive any questions for this episode of the show in advance, and so I just wanted to remind our viewers and listeners that you can do so. If you have a question for us for a future episode or on anything you have seen or read from AAII content, please send an email to kworth@aaii.com with the subject line II Show Question. We will try to get it on air for the next episode.
And now a word from our friends at Discover Bank, sponsor of the Individual Investor Show and AAII webinars. We know as individuals interested in building investor wealth, you never want your money to be idle. Even small dollar amounts for short amounts of time should be working for you. With that, we're pleased to share information from our partner, Discover Bank, on deposit accounts that keep your money moving. You can choose from several options to help you meet your short-term or long-term financial goals. The best part? All of the deposit accounts offer preferred member rates. Please take a look.
If you liked our show, please visit aaii.com/webinars to register for more webinar and video content. Like us on Facebook and follow us on Twitter at @AAII_invest_ed. For more investing education, check out our site, aaii.com. I want to thank our guests, Matthew Crouse, Charles Rupplet, and Matt Bykowski, and you for listening. See you next time.